from Hello everyone, we are group 4 from MBA 212 and our group members are Frederick, Lisa, Jordan, and myself, Kylie. And today we will present our investment recommendation based on the analysis of two major automotive companies, Tesla and General Motors. We will use a ratio analysis and cash flow calculations to support our recommendation and provide insights to the financial performance of both companies. Hello everyone, we are beginning with Tesla Incorporated. Tesla is an innovative leader in electronic vehicle and renewable energy markets. The company's mission is to accelerate the world's transition to sustainable energy through its range of electronic vehicles, energy storage products, and solar energy solutions. Tesla's product lineup includes popular models like the Model S, Model 3, Model X, and the Model Y, as well as solar panels and energy storage solutions such as the Powerwall. As we are looking at Tesla's recent stock performance, the data including the market cap, trading volumes, and valuation ratios give us a snapshot of how the company is currently performing in the stock market. And Tesla stock closed at $230.17 and opened at $232.64, indicating a slight increase, suggesting a positive investor sentiment for the start of the trading day. With the market cap standing at $673.2 billion, places Tesla among the largest companies in the automotive industry, with market dominance, particularly in the electronic vehicle sector. And the current trading volume is over 112 million shares compared to an average volume of around 97 million shares. And when the actual volume surpasses the average volume, it often indicates increasing trading activity, possible driven by recent news or investor reactions. The beta value of 2.29 indicates that the Tesla stock is over twice as volatile as a market, which means that the stock can offer high returns and carries a higher risk of price swings, and that is something investors need to be mindful of. And then the earnings per share of 3.56 shows that Tesla is profitable on a per share basis despite its heavy reinvestment in expansion and innovation. It reflects the company's ability to generate earnings as they grow rapidly. Tesla's governance quality score is currently 10, and that score is reflecting higher governance risk compared to its peers. But with the audit being 7, indicating moderate risk for financial reporting and oversight, the board structure is 9, which suggests that the board may lack significant independence or diversity. The shareholders' rights is 9, highlighting potential issues in the power balance between shareholders and management. And compensation is 10, at the highest risk level, suggesting that the executive compensation practices might not be fully aligned with shareholders' interests. And with Tesla's governance score of 10 is double-edged sword. It underscores the need for stronger governance practices, but it reflects the complex dynamics of the company that's pushing boundaries. For those willing to take a risk, it's a part of the package that comes with investing in a groundbreaking company like Tesla. Next, moving on to Tesla's major shareholders. They're a mix of institutional investors and individual stakeholders, which include Elon Musk, which is the CEO, and he's the largest individual shareholder. And all the shareholders have a strong influence over the company's strategic decisions, which can impact Tesla's growth and innovation trajectory. Some of Tesla's top institutional holders include Vanguard Group, BlackRock, and State Street Corporation. Tesla Motors key executives include Elon Musk, which is the tech-knocking of Tesla, and it's reflecting his unconventional approach to leadership. Mr. Tanida, is the chief financial officer and plays a pivotal role in managing Tesla's finances and ensuring financial stability. And also Mr. Xu, and he is responsible for overseeing Tesla's automotive segment, which includes production, sales, and delivery of vehicles, and including more other key executives, but those are the top three. Tesla's ESG risk rating stands at 25.2, indicating a medium level of risk overall. While the company excels in environment and initiatives with low environmental risk score of 3.3, it faces a modern social risk at 14.1 and a higher governance risk at 7.8. This governance challenge, such as board independence and executive compensation, contribute to this elevated score. Tesla's controversy level is also significant, reflecting ongoing issues that may impact its reputation and investors' confidence. Overall, while Tesla leads in sustainability, its governance and social practices require attention for long-term stability. Now shifting gears into our next company, which is General Motors, or GM, is a global automotive leader known for its diverse vehicle lineup, which includes brands like Chevrolet, GMC, Cadillac, and Buick. And recently, GM has been making strides towards their electronic vehicles and autonomous driving technologies as a part of their vision for zero emissions future. That shift is crucial for GM to stay competitive and evolving in the automotive market. GM stock opened at $48.07, which was slightly higher than its previous close of $48.03, with the day's range of $47.01 to $48.65, indicating moderate volatility, and the 52-week range of $26.30 to $50 highlights significant fluctuations over the past year. With the market cap of approximately $53 billion, GM is a key player in the automotive industry. Though it's much smaller than Tesla, the current trading volume of 15.5 million shares is above the average of 14.3 million, showing increased investor activity. GM's low PE ratio of 5.30 suggests that it may be undervalued, while its EPS of 8.90 reflects strong profitability. The beta of 1.44 indicates moderate volatility, making GM an appealing option for value investors seeking stability with some potential growth. For GM's corporate governance, it had an ISS governance quality score of 9, indicating a higher governance risk, particularly in compensation practices. While it scores well on audit and shareholder rights, the high compensation score of 10 suggests potential concerns for over-executive pay alignment with shareholder interests. GM shares are predominantly held by institutions, with 88.33% of shares and 88.54% of the float controlled by institutional investors. This is a high level of institutional ownership, indicates strong confidence from large-scale investors in GM's long-term stability and potential. However, only 0.24 of the shares are held by insiders, suggesting that limited personal investments by executives and board members in the company. With 1758 institutions holding shares, GM's stock is heavily influenced by institutional activities, making it important for the company to maintain strong relationships with these investors to support its stock price and strategic initiatives. GM's top institutional holders are BlackRock Incorporated, Vanguard Group, and State Street Corporation, just like Tesla's. General Motors' leadership team is headed by Mary Barra, Chairman and CEO, with Mark Reuss as the President and Paul Jacobson as the CFO. And their collective expertise drives GM's strategic initiatives and operational efficiencies. General Motors has a total ESG risk score of 28.5, placing it in the 63rd percentile, which indicates a medium level of risk. The environmental risk score of 9.8 reflects significant changes in managing environmental impact. The social risk score of 11.5 and government score of 7.2 suggests that there is moderate concerns in areas like labor practices and corporate governance. Additionally, GM has a high controversy level of 4, indicating significant ongoing issues that could impact its reputation and investor confidence. Now we could shift gears into the ratio analysis for Tesla and GM.
A liquidity ratio is a financial metric that measures a company's ability to pay off short-term debts with current assets. It's a representation of a company's financial health and operational effectiveness. The current ratio is a key liquidity metric that measures a company's ability to pay its short-term liabilities with its short-term assets. A ratio above 1 shows that a company is in good financial health. The quick ratio assesses a company's ability to pay off its current liabilities using its current assets. The higher the quick ratio, the better a company's liquidity and financial health. A company with a quick ratio of above 1 has enough current assets to fully cover its liabilities. In the liquidity ratio, it shows that Tesla has a higher current and quick ratio than GM, meaning that Tesla is better and has more resources and assets in covering its liabilities. Therefore, Tesla would be the better company that meets its current obligations. Asset management ratios represent how proficiently an organization utilizes its assets to create revenue. A higher ratio shows a company is using its assets more efficiently, while a lower ratio indicates less efficient use. The inventory turnover ratio is a measurement that shows how often a company sells and replaces its inventory during a specific period of time. A high ITR shows that a company is efficiently managing its inventory and working capital. This can lead to lower storing costs and larger profits. A low ITR shows that a company may be overstocked, which can lead to higher storing costs and potentially outdated inventory. The inventory turnover ratio calculates how many days it takes on average to sell its inventory. The day sale outstanding is the average number of days it takes a company to receive payments for its sales. A high number suggests that a company is facing delays in receiving payments, which can result in cash flow problems. A low day sale outstanding shows that a company is getting its payment on time. The payments received can be put back into the business for reinvestment. A day sale outstanding under 45 days is considered low. The asset turnover ratio shows how efficient a company is using its assets to generate revenue. The higher the asset turnover ratio, the more efficiently a company is. When a company has a low asset turnover ratio, it means it is not efficiently using its assets to create revenue. Comparing the two companies, it shows that GM has a higher inventory turnover, meaning that it can turn over its inventory more times in a certain period than Tesla can. However, Tesla's days in sales outstanding, it's lower than GM's days sales outstanding, meaning that Tesla can receive its payments from its sales in a lower amount of days, so they have more reinvestments that they can do in a shorter period of time. And as far as total assets turnover, it shows that Tesla is more efficient in turning over its assets than GM can. A debt ratio is a ratio of total debt to total assets. It is shown as a decimal or percentage. It is explained as the amount of a company's assets that are financed by debt. A debt ratio of more than 1 or 100% means a company has more debt than assets. A debt ratio of less than 1 expresses that a company has more assets than debt. An equity multiplier is a ratio that computes how much of a company's assets are financed through a stockholder's equity. A low equity multiplier shows a company is using more equity and less debt to finance investment of assets. Organizations with a low equity multiplier are viewed to be less risky investments because they have lower debts. This can also mean a company is not incurring excessive debts to fund its assets. Instead, the company issues stock to finance the purchase of assets it needs to operate its business and raise its cash flows. However, a high equity multiplier may reflect a company's effective business strategy that allows it to acquire assets at a lower cost. The times interest earned ratio determines how well a company can pay the interest on its liabilities. It measures a company's capability to meet debt obligations based on its current income. The higher the ratio, the better, as it shows how often a company can pay its debt with its current earnings. It can also mean a company has enough cash after paying all its debts to continue to reinvest in the business. In the debt management ratio category, Tesla seems to be doing a better job than GM, as its debt ratio is lower than GM, meaning that it has less assets financed by debt. Also, in the equity multiplier, Tesla also has a lower equity multiplier, meaning it is using more equity than it is using debts to finance its assets. And in the times interest earn ratio, it shows that Tesla can pay its debts many more times over than GM can, meaning that Tesla has more cash to put back into stockholders' equity or reinvest again in its business. Overall, Tesla seems to be the better company in this debt ratio management comparison.
So here are the profitability ratios for Tesla and GM. On the left, you see Tesla and their gross profit margin had fallen slightly from 25.28 in 2021, 25.60 in 2022, and then down to 18.25 in 2023. But they're still a lot higher than GM's profit margins, which were 7.34 in 2021, 6.58 in 2022, and 5.40 in 2023. Those have also dropped in the last 3 years, but Tesla is still having a higher profit margin. The net profit margin and the operating profit margin it looks like for the operating profit margin, it went from 11.43 in 2021 to 16.53 in 2022. So it went up a little bit in 2022 and then down to 9.03 in 2023. GM's has had like a little steady decrease. 2021, it was 6.59. 2022, it was 5.95. And 2023, it was 4.88. Their net profit margin kind of did the same thing as the operating profit margin. For Tesla, in 2021, it was 10.13. 2022 was 15.14, so it went up. And then in 2023, it dipped back down a little bit at 14.19%. The ROA for Tesla was 8.78 in 2021 and 14.98 in 2022 and 12.88 in 2023. The ROA for GM was 6.82% in 2021, 7.41% in 2022, and 7.70% in 2023. So their ROAs are still higher than GM's. Their ROEs, return on equity, for 2021 for Tesla, it was 17.58. For 2022, it was 27.11%. For 2023, it was 21.68. So again, 2022 seemed to be a good year for Tesla. The ROEs for GM, 2021 it was 8.51%, 2022 was 10.34%, and 2023 was 11.47. The basic earning power for Tesla was 9.90% in 2021, 16.35% in 2022, and 8.19% in 2023. The basic earning power for GM in 2021, it was 3.42%. 2022, it was 3.53%. And 2023, it was 3.07%. The earnings per share were really low in 2021 for Tesla. Then they increased to 3.94 in 2022, and then up to 4.33 in 2023. The earnings per share for GM went from 3.86 in 2021 to 5.15 in 2022 to 5.74 in 2023. So GM's earnings per share are slightly higher than Tesla's. The book value per share for Tesla was 10.20 in 2021, 14.28 in 2022, and 19.73 in 2023. And the book value per share for GM was 41.17 in 2021, 46.91 in 2022, and 47.13 in 2023. So the book value per share for GM is higher than the book value per share for Tesla, but it does seem like Tesla had a not so good year 2021, a good year 2022, and then a not so good year 2023. GM kind of just has like a steady, small decrease from 2021 to 2023.
So as far as cash flow from assets goes, we got all of our information, obviously, from the financial statements, in which the cash flow to creditors, we took the interest paid minus the net new borrowing. For the cash flow to stockholders, we took the dividends paid minus the net new equity raised. We took the sum of those two, and that's how we got the cash flow from assets. For the operating cash flow down the next section, we took the EBIT, which is the earnings before interest and taxes, plus the depreciation minus taxes. For the net capital spending, we took the ending net fixed assets minus the beginning net fixed assets, plus the depreciation, and that's how we got that value. And then the last one, the change in net working capital, we just took the ending net working capital for the year minus the beginning net working capital, and that's how we got that value. So for the cash flow from assets, for those three, we took the operating cash flow minus the net capital spending minus the change in net working capital, and that's how we came up with that value. So for Tesla, for example, each year from 2021 to 2023, they had more and more cash going into their assets and spending more cash on their assets and their operations, with less cash coming in. For as far as General Motors, they had more cash coming in to their business rather than spending more on their assets operations, as you can see from the total values for each, as Tesla is on a from 21 to 23 is decreasing in value, which is more cash going into their assets, rather than General Motors, they're increasing in value because they're bringing in more cash to their operations rather than spending it more.
So, as investors, we decided to invest in Tesla over GM because one, Tesla is still profitable, even though profit margins have been down the last couple of years. Their net income has still been increasing, and they still have growth potential since they're still a high growth stock because they focus on innovation in EVs, batteries, and energy solutions. There's still that room for them to grow. They also have a strong market position. So with Tesla being a leader in the EV market, they're also expanding to other market segments, like with their batteries for homes with solar. Different market segments just add to their revenue that just makes them even more profitable. Thank you.